Hi, it's Frank from CappThesis. Today we'll be looking at the S&P making new all-time highs again. More importantly, how it did it this time. So looking at the first chart is exactly what we're talking about. It made a new high by achieving an upside target of 49.20. Now this was from a relatively small bullish pattern, but important nonetheless, because we had another instance where there is a identifiable bullish formation, right? Cup and handle looks like, to me at least. We saw a breakout. That breakout zone was never violated, and a few days later, we achieved the target. That's important because it's come after the bigger breakout, the much bigger breakout, which has been in place since December 1st. And once that happened, right, it's the same type of deal where no pullbacks of meaningful significance came back down and tested this zone, which then gave the S&P the ability to come up here, again, formed a consolidation pattern, which turned into that bullish formation, and then accelerate higher from there. And if you think about it, this is really what the epitome of an uptrend is, seeing bullish patterns form over and over again, and most of the time having them resolved to the upside, sometimes bigger in nature like this, sometimes smaller. And this is really how it all began back here, where of course the huge move off the lows kickstarted momentum, but from a chart pattern perspective, in my eyes at least, it was more important to see this consolidation pattern, consolidation zone hold, and then create the breakout, and off we went from there. So again, best case scenario, see more of the same of this, knowing that not every bullish pattern that we see is going to have its upside target achieved, especially the smaller ones. Until we see a trend of them failing, we have to respect what's going on still. And so, looking at all of these together, sometimes it doesn't always play out. This is why we have to view each one independently of one another as they pop up. And so we saw the first attempt of a bullish pattern being formed on the way down, really in the early part of September, never got back up to the key resistance zone. And then again from late September to early October, got closer, still didn't break out. So then the next one, which we just reviewed, finally saw the breakout. Again, don't forget, not many people believed this was going to be possible because we're still in the downtrend. Not too much had changed from an economic standpoint, so forth and so on. But we know from a price action perspective, it was much different once that breakout occurred and extended further from there. And so another way to look at this is just group them all as if they're just big trading ranges or trading boxes, as we've been calling it at CappThesis. So on the way down, those trading boxes just led to downside breaks, right? So resolve to the downside, it just means you're in a downtrend. It changed here. Another box was identifiable, but we didn't see the downside break even though the market was making new lows, right? And so when it held that and then broke above the box, then of course things changed. Here we are again, right? So good breakout to new all-time highs again. You have to assume at some point we're going to have another sideways movement, whether that's more volatile after the Fed, after some of these big names to report remains to be seen. But again, we'll try to group this in the same way and see which side takes over from there. And so one of the key things, of course, is continuing to track the 1% moves. Talk about all the time, tracking 1% moves is a very good way to identify two-way volatility. 2022 had almost 131% moves up and down, an average of about 11 per month, which is a lot. And we had this highlighted because that remained the case in the first quarter of 2023. In particular, I want you to focus in January. January of last year, S&P was up over 6%. It did it with 6 1% advances, but also 3 1% losses for a total of 9. That just told us that the two-way volatility was still around, right? And so even though we had some really good moves, we know how February reversed that pretty drastically. And again, the big moves stayed with us until the start of the second quarter. And since that time, other than the 8 that we had last October, it's been a lot less volatile from that sense, right? And so that gives the S&P the ability to break out and again, have those breakouts be clean. We don't see many whipsaws on the way back down. And so you compare that this January, where again, 9 1% moves with a 6% gain, to this January right now, S&P currently up about 3% with a few days left, only 2 1% advances, obviously no 1% losses. So in this sense, it's healthier, right? A big reversal could come at any time, but we want to try to track the behavior changes underneath the surface. And so far, there isn't too many of those of note as of right now. And so we can also look at this, right, in terms of what the trend is by looking at the S&P right now trading above each moving average trending higher. It's been the case now for a number of weeks. Only time that really came in was tested was when the 20-day moving average was undercut a few times in December, and then again a few weeks ago. Clearly, they didn't lead to a reversal as it did here. And this is just a 14-day RSI, as we know, overbought again. And also the Williams %R, which is one we don't talk about a lot. Similar to the RSI, it doesn't take as much to move it. I mean, if you have a few big down days, it can get moved from overbought to oversold pretty quickly. And so this is important because just being oversold, just being stretched, we know hasn't mattered, right? You had an overbought condition for the S&P 500 in the middle of November, now over 2 months ago. So we need more than that. So it's much more important to try to detect when a shift in momentum is underway, right? And that's never going to help us pinpoint the top, but it's going to help us stay within this uptrend for longer. And so we talked about different ways for that to happen. Another way is to track when the RSI goes below the 50 zone or thereabouts at the same time that the Williams %R is oversold, right? Again, this gets knocked down pretty quickly, but when that's occurred after previously big advances, right, from the spring and summer, and also from the beginning of the year last year, it did lead to additional downside, additional volatility. So again, this is going to put us all the way, below the high when this occurs. Will hopefully give us a chance to identify it as it happens, as opposed to trying to guess when the top is going to be. So we'll be watching that through the end of January into February. We'll be updating everyone along the way. Check out these videos and subscribe. I'll talk to you next time. Thank you.